Salam everybody, this is Investor Sheikh back at it again with another video. I just want to say Eid Mubarak to everyone, and I hope you had a great Eid and you spent it with your family and friends. And if you got Eid, I hope you invested it in some quality stocks. Now today I want to talk about dollar cost averaging, which I believe is very important to becoming a successful investor. Now, dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. The purchases occur regardless of the asset's price and at regular intervals. In effect, this strategy removes much of the detailed work of attempting to time the market in order to make purchases of equities at the best prices. Dollar cost averaging is also known as the constant dollar plan. So, recently we've seen a huge sell-off in growth stocks. And if you're someone that invests in growth stocks, you have to understand that on certain moments, they will go up significantly. But if a sell-off were to happen in the overall market, growth stocks tend to go down the most compared to dividend stocks or stocks from companies that have been well established for decades. Now, the reason being is that some people they put a lot of money into these growth stocks and will take their money out as soon as they can if they see the market start to dip. And usually if the stock price goes down significantly, that may lead to a decreased market sentiment, which means people may not want to invest in the stock market anymore because they've seen their positions go down significantly. And lately I've noticed that there have been some YouTubers who've stopped making videos recently because a lot of the stocks that they've been talking about on their videos have been going down significantly. And their subscribers are basically asking them, what's going on? Why are your stock picks going down? And this just shows you that you really shouldn't rely on YouTubers for stock advice because they're not financial advisors. They're just retail investors that are investing in the stock market, just like you are. And they don't know how the market is going to react to certain things. And I know that the sell-off that we've been seeing is one of the reasons is due to inflation that is occurring in some markets right now. But if you're dollar cost averaging, that shouldn't be a big deal because you are consistently investing in a stock weekly or monthly. So for example, one of the stocks that I dollar cost average on is Tesla. I believe Tesla is going to be a successful company long term, regardless of any short term volatility that happens in the company or the stock. Now, we've seen Tesla stock go up as high as $880. So let me just pull up Tesla right now. So on February, we've seen it as high as $880, and now it has dipped to the high 500s. Now, as you may know, February was definitely the time when a lot of the growth stocks peaked. So for example, NEO, it was at $60 back in February, and it dipped to almost half the stock price. So it's at $33 right now. And then a stock that I was talking about, Teladoc, it was as high as $300, and it is cut more than half that to $140. So this just shows you how growth stocks normally function, especially when it comes to short-term volatility. They will reach all-time highs, but they will go down significantly. So if your portfolio consists of mainly growth stocks, you may be experiencing some of that pain of your portfolio being lower than ever before. So if you are investing in growth stocks, they should definitely be companies that you are knowledgeable about and that you've done the research on, whether it's looking at the 10K, the earnings report, looking at who the CEO of that company is and whether they are managing the company the right way, whether you're reading articles related to the company, as opposed to a random stock that a YouTuber is talking about. If they want to invest in that stock, let them, but you as the individual should decide where to put your money at. Because if you believe in a certain company and you believe that they will do well in the long term, the short-term volatility should not matter. After all, if you want to get long-term gains, you have to go through the short-term pain first. And right now, this is the short-term pain. If you can't handle it and you end up selling your stocks when they dip so low, then you've officially lost your money in the stock market. After all, if you're down big on your portfolio, technically you didn't lose money. Those are unrealized losses. It's only officially a loss if you sell the stocks. So going back to dollar cost averaging, it's pretty much making it a habit to invest a certain amount of money at a certain frequency, whether it's every day, every week, every 2 weeks, or every month. So for example, I'll put $100 every 2 weeks for stock XYZ, regardless of the stock price. And I do that for 5 or 10 years. The future me is going to thank the present me for doing that, for engaging in that habit, because consistency is key to becoming a successful investor, to building long-term wealth, as opposed to being a day trader. I know people saying buy low, sell high, but the same logic can be applied to dollar cost averaging. If the stock price drops significantly and it's a company that you believe in, it wouldn't hurt to invest a little bit more money than you usually would. So if you usually invest $50 a week and the stock price dipped to well below your cost basis, it wouldn't hurt to put $200 when the stock price dipped. So let's look at the reason why investors use dollar cost averaging. So the main reason is that it reduces the effect of investor psychology and market timing. So investor psychology, market timing on their portfolio. By committing to a dollar cost average approach, investors avoid the risk that they will make counterproductive decisions out of greed or fear. Now those two words, greed and fear, when it comes to investing in the stock market, greed and fear are two emotions that are common out of people. Now greed happens when you're up big in the stock market, but you feel like you want to earn more. Let's say you've invested in a stock and it has gone up 200%. You might not feel satisfied by that, and you want to see the stock go 400%. So you're still holding on as opposed to selling it and locking in those gains. That's greed, and that's no different than betting your money on the roulette table. You may bet on black, and it'll be black, but instead of taking your money and cashing in the chips, you're like, let me go at it again. Let me go for black one more time. That's greed. Fear is you being afraid of losing your money in the stock market with a crash. Sometimes you see stocks that are at all-time highs, and you might be afraid that you may not see those stocks at that price anymore, and you may have fear that the stocks will crash and you'll lose a lot of your money. So honestly, those two emotions are very unhealthy when it comes to having an investing mindset. And frankly, I don't believe it's halal to really engage in those two emotions. And that's typically what would happen if you are putting your money in stocks like I just heard about, penny stocks, growth stocks, etc., etc. So, some of the ways that you might want to mitigate that would be to diversify your portfolio. It wouldn't hurt to, maybe invest in a few growth stocks, but also add some stocks from companies that are well established, that have been around for decades, like Nike, Johnson & Johnson, Kimberly-Clark, and even Apple. Apple's a tech stock, but they've had consistent gains over the past 30, 40 years. So, and also, you should probably add some ETFs in your portfolio, because they diversify as well, so that you don't have to diversify by buying individual stocks. So that's one alternative. This is Investor Shake checking out. And remember, consistency is key to success in the stock market.